Hi, I'm Paul Sinnott, President of Plaza Mortgage Group. Thanks for coming to the website to educate yourself about adjustable rate mortgages. What is an adjustable rate mortgage? Well, first of all, it's just that. It's a loan that's interest rate changes on a periodic basis. It's different from a fixed rate mortgage in that a fixed rate mortgage, when you close on the loan, the interest rate's set for the life of the loan. An adjustable rate mortgage has some periodic adjustment that's outlined in your original loan documents. First, let's talk about the different types of adjustable rate mortgages. There's a one-year adjustable rate mortgage, and that's a loan that does just that. Its interest rate changes every year. There's a 228 adjustable rate mortgage where the rate's fixed for 2 years, and after that time period, it may be fixed for the remaining term of the loan, or it may change every 6 months or every year. Again, the initial paperwork will determine how that adjustable rate mortgage changes. The most common types of adjustable rate loans are 3-1 ARMs and 5-1 ARMs. And the way a 3-1 ARM works is the interest rate's locked in for 3 years. At the end of that 3-year period, the loan becomes a 1-year ARM, and the interest rate will change every 12 months from that point. A 5-1 ARM works the same way, only it's locked in for 5 years, and then again, after that 5-year period is up, it turns into a 1-year adjustable rate mortgage. There's 7-1 adjustable rate mortgages and 10-1 adjustable rate mortgages, and those work the same way that 3 and 5-1 adjustable rates work. Those are fixed for 7 years and 10 years respectively, and then they turn into a 1-year ARM. Another loan that was sold and was fairly popular in the last few years was something called a payment option ARM. And a payment option ARM gave you a really low first-year interest rate, an introductory rate that was kind of a little bit of a teaser, and that adjustable rate mortgage, it would either change every month or every 3 months or every 6 months. And you had the option of paying interest only, or there were certain payment caps so that you could pay the minimum payment. Okay. Now, what happened with loans like that, many of those loans contained something called negative amortization. And negative amortization occurs where if a customer chooses to make the minimum payment, it may not be enough to cover the interest portion of the payment, and the additional interest is added to the loan. So rather than the loan balance coming down, the loan balance actually went up. That's called negative amortization. Now, let's talk a little bit about how adjustable rate mortgages work.
Okay, let's talk about how interest rates are calculated for adjustable rate mortgages. The interest rate is calculated by using a specific market index like the Treasury bill, cost of funds, or London interbank offer rate. The index for your ARM is specified in your adjustable rate rider on your original loan paperwork. The current index rate is added to the margin, also specified in your loan documentation. A typical margin is 2.75%, although it could be more or less depending upon your note. Therefore, if the current index rate is 5%, adding the 2.75 margin will give you a total interest rate of 7.75%. Interest rate caps also affect the interest rate by capping the amount that your interest rate can go up or down. The most typical caps are periodic adjustment caps and life of loan caps. If your periodic cap is set at 2%, then your interest rate cannot go up or down more than 2% on any given adjustment. So if we use our first example, let's say that currently your interest rate is 6%. The current index is at 5%, and the margin from your paperwork is 2.75%. The calculated rate of index plus margin is 7.75%, which means that your current rate of 6% has gone up 1.75%, which is less than the maximum rate cap of 2%. However, if the index had been at 6%, adding the margin of 2.75% would force the interest rate up to 8.75% over the limit of the rate cap. Therefore, the new rate would be capped at 8%, the maximum increase for that adjustment period. Most ARMs also have a life of loan cap that prevents the total percentage the rate can increase or decrease during the life of the loan. Let's say that in our example that rates steadily climb and that now our loan that started at 6% has adjusted upward to 10% over the years. The current index is 10%, which when our margin of 2.75 is added, makes the new rate 12.75%. But because our loan has a life cap of 6% total adjustment, the initial interest rate was also 6%, the interest rate would be capped at 12%. Even if the index continues to climb in the future, the interest rate on this loan would never climb higher than 12%.
And again, all this information is in your initial paperwork. You can find the information you need on your adjustable rate note and your adjustable rate rider. Those are the two documents that contain all this information. Another thing that I just want to briefly touch on are prepayment penalties. First of all, what is a prepayment penalty? A prepayment penalty is just that. It's a penalty for early payoff. Sometimes a prepayment penalty is 2 years, sometimes it's 3 years, sometimes it's 5 years. And again, the amount of that prepayment penalty can be different. Some of the prepayment penalties are 6 months worth of interest. Some are 2%, some are 3%, some are 5%. Again, all that information is going to be on your adjustable rate note or your adjustable rate rider. And again, how do you know if you have one? There'll be a specific area on that note that talks about prepayment. So that's how you can figure that out. So hopefully you know a little bit more about how adjustable rate mortgages work. If you have an adjustable rate mortgage and you're concerned about it, you may be asking yourself, what should I do? And I think the key is you need to determine what kind of adjustable rate mortgage you have. And again, an experienced mortgage loan consultant can help you with that. We can look at the paperwork, and you can fax or scan an email that adjustable rate note or that adjustable rate rider, or your truth in lending disclosure. Those are all closing documents that you'll have in your initial loan package. So again, what to do? Find out what kind of an ARM you've got, what kind of an adjustable rate mortgage you've got, and contact an experienced mortgage loan consultant. So thanks for watching the video and taking the time. I hope you found it informative and educational. Have a great day.